We're back. It's a Real Estate Momentum podcast, and I've got my friend Ravi Patel. He's with Guaranteed Rate right here in Northern Kentucky. And Ravi and I had a great conversation about a week or two ago. There's a lot going on in the mortgage industry right now, if you guys didn't know. And my goal is to bring all this information to people who are watching, people here in Northern Kentucky, or people anywhere for that matter, just to kind of set the record straight on the finance side of the business, because there's a lot of questions around it. Yeah. So, Ravi, what's up, dude? How's your mindset right now with what's going on with all the changes in the mortgage industry?
Well, this year's been just a little weird compared to the last couple of years, right? Last couple of years just been a little too easy, not just for lenders, but for agents as well. This year's been a little bit more difficult, and you're here, or people are just seeing a lot of creative financing out there. And the first thing when they see creative financing, people are getting worried about, what does that mean? Are we going back to 2008, 2009? It's a matter of dissecting all the different loan programs that are available now to combat the fact that, hey, interest rates are at a 15, 16-year high.
So when you say creative financing, as a real estate investor, I automatically go to like seller financing and stuff, but you're probably talking about things that you can help with.
So creative financing, and every lender's different, right? And they have different programs and things of that nature. But creative financing can be a 2-1 buy down, for example. Yep. A 2-1 buy down, which I'm sure you've seen a lot of marketing on at this point, where we get the sellers to pay X amount towards closing costs to help the buyer buy down that rate for the first year by 2% and the second year by 1%.
Well, and like you zoom out for a second and you look at why is this even a thing?
Yeah.
And it's because people were getting 2.5%, 3% mortgages for, we call it 18 months, 24 months.
Yeah, close to about 18 to 20 months, yeah.
Yeah. And when you're like, hold on a second, you just pre-approved me to buy this house, this big house, for that payment? Like, that's pretty awesome. And we kind of got used to it. It created this, oh man, I'm pre-approved for this amount. Well, and the Fed says, okay, well, inflation's going up. We got to slow this down. Let's raise rates.
Yeah.
And then that all hit us, and we're like, all right, rates are going up at the Fed. We got to start preparing for mortgage rates to go up. And we're all like, they won't go up that fast.
Yeah.
And what happened?
It happened pretty quick, right?
Quick, it was rapid.
And it happened, and for example, I think December 30th of 2021, right, it was like rates were in the low threes. And by the time January rolled around, we were in the mid threes. February went into like the high threes, low fours. And then within a 6-month period, we went into the sixes.
So essentially what happened was we're driving above the speed limit.
Yeah.
And then we see a cop. And we just we jam the brakes. Everything kind of just slows down. And then kind of we let off the brake. And now we're kind of rolling at the speed limit.
Yeah.
Or we're kind of just cruising right now because rates haven't really jumped drastically lately. They're kind of ebbing and flowing, right?
Yeah.
But essentially all of a sudden kind of like that June to September, everybody just slowed way down. Yeah. And now we're just kind of coasting.
Yeah. So what happened was, obviously the Feds got involved. They had to raise the interest rates, right, on their end to where they can control inflation. And things start kind of going up and down around May and June. And June was a huge month. We saw some downward spiral of interest rates going down sometime in July and August, and then just start trending upwards. And to a point where, when rates go up, buyers are losing power, purchase power, right? So when that happens, they're kind of hearing from family and friends, hey, take a step back, let this kind of die down a little bit. What happens to the market?
Wait for the market to crash.
Wait for the market to crash, Yeah. And that saying has been every year people have been saying that.
Yep.
It's just not going to happen, right? It's just one of those things where the supply in the market, meaning listings and things like that, we're still at an all-time low. It's not like we've got more listings on the market.
Yeah, inventory is crazy low, and an example of that conversation is I talked to a previous client. He was able to find a buyer to buy his house through just kind of chatting, right? I think somebody's like, oh, so-and-so's looking for a house in your neighborhood. They connected. So-and-so bought this guy's house, and he reached out to me. He's like, hey, I'm considering doing a rental. My first thought was like, oh, man, are they getting a divorce? Like, what's going on? Yeah. But he's like, no, I sold my house. He's like, the market's about to crater. I was like, awesome. Where'd you get your crystal ball?
Yeah.
Because I didn't hear the market was about to crater. He sold his house. I'm going to say it's probably in the $500,000 range. Dude probably had a 3% or 3-point-something% interest rate.
Something pretty nice, yeah.
Well, fast forward to today, the market's not cratered. And this was probably 14 to 18 months ago. The market's not cratered. and the interest rates are now double.
Yeah.
So for him to go back and buy that same house, his mortgage payment is going to be $1,000 to $1,200 more.
Yeah.
So it's like, people speculating what's going to happen with the market. People just need to slow down and think.
Yeah. And for example, that client of yours, right?
Yeah.
If he has, obviously he sold at an all-time high. So I'm sure he made some money from the sale of his house.
Without a doubt.
Right? That means that he has a substantial amount to put down on a new home. Well, when you have substantial amount to put down, let's say I won't say 5, let's say 10, 15, or 20%, that's when creative financing comes into place. That's when lenders can talk about, adjustable rate mortgages. And the first thing they hear about adjustable rate, the first thought is 2008 again, but it's long-term adjustable rate mortgages, right? So he can probably get into, let's say, a fixed rate for the first 10 years, almost 2% lower than what a 30-year traditional mortgage is going for right now.
Yeah, so let's unbox that for a second. The other day, I put out a video that talks about assumable loans. We'll just set those off to the side for a second, because you don't go looking for a house with an assumable mortgage on it and just buy it because it has an assumable loan. You have to like the house first, and then that just kind of has to be something that comes after the fact.
Yeah.
So let's talk really quick. Actually, we don't have to be quick about this. Let's talk about those creative financing when it comes to the adjustable rate mortgage, which everybody treats like that. I don't understand it. I think it's bad, but I'm not really sure.
Yeah.
And then the 2-1 buy down. We might talk about when would these things come into play.
For sure.
Right.
So we'll go into the arms first, and for the audience, like I'm personally on a 10-1 arm, right?
Your personal home.
My personal loan's on a 10-1 arm.
Okay.
I think I'm locked at a 3% interest rate. I still have 7 more years left.
Nice.
Right? 7 years. I mean, I'm probably not going to be in this house that long. I probably pay it off. My kids are young, so they'll probably grow out of it. Things like that. So the thing here is that I'm personally on one. I kind of understand the pros and cons, so I can kind of explain to a client that, hey, this is how it works. These are the questions that you need to ask, and these are the answers to those questions.
Yeah. So tip of the iceberg on an adjustable rate mortgage. What are the bullet points? Just
so the bullet points, and they're different type of adjustable rate mortgages. You got something called a 3-1, a 5-1, 7-1, 10-1, all the way up to a 15-1. And the first number, what that stands for, is that how long is that initial interest rate fixed for?
Okay.
So, for example, a 15-1, let's say hypothetically speaking, the interest rate's 6%.
Okay.
So today, it's still a 30-year mortgage, but for the first 15 years, that interest rate's fixed at 6%, which is almost a full percent lower than a 30-year traditional mortgage.
Got it.
Right?
Okay.
So it's just a matter of individual's risk. I had a client that, I always tell people, I'm not a gambler. So I love my 7-1 and 10-1 arms. Those are very sweet spots because that's a long time. And then he's like, hey, well, Ravi, you're offering a 5-1 at 5%, which is a 0.5% better than a 10-1 arm. Give me the 5-1 because I know in about a few years, interest rates are going to go down. Now, he says it pretty confidently. I tell people, yes, interest rates will most likely go down end of next year, beginning of 2024. That is what the industry standard is. That's what they're kind of projecting at this point. Nobody has a crystal ball, like you said. So we don't know 100% sure, but we know that everything that the feds are doing now to control inflation, plus with the CPI, Consumer Price Index, right, is that the Consumer Price Index is that with all this happening, rates should go down to what they were pre-COVID. Back in 2019,
right?
Which I think rates were hovering before COVID had happened somewhere in the mid-4s, high 4s. And the market was great, right? Gas prices were a little bit lower. People were selling real estate.
Home prices were still on the way up.
And home prices were still appreciating. It wasn't depreciating, right? And so it's one of those things where that's our goal is to, if a client has 10% or 15 or 20, right? It's like, hey, this is what a 30-year traditional mortgage looks like. We do have these long-term ARM products. And I have to say long-term because we're trying to get away from what happened in 2008 where people were getting, a year teaser rates at 1% and then all of a sudden their rate went up to 20% the next year. And they can't afford these houses anymore. That's not these products, basically. There's a cap on them per year, meaning after year 10, let's say, for example, your rate can only go up about 2%.
Okay. So you're on you said a 3% 10-year ARM.
So as of right now, our 10-1 ARM currently today is at 5.5.
On the one that you're in your house.
Oh, 3%.
Right. So you're on a 3% adjustable rate mortgage. You got it for the next 7 years. In 7 years, the mortgage rate of the day would be let's just say in 7 years the mortgage rate is 8%.
Yeah.
Again, no crystal ball here, but I'm just throwing it out there. the most your mortgage can adjust in year 11 for your mortgage that you're on right now is up from 3% to 5.
To 5.
Right.
Yeah. And then year 12 from 5 to 7. And then there's a lifetime cap of 6.
Right.
So it could go from 6 all the way up to 9 over a 30-year span, correct?
But you've got that 10-year window from the time that you mortgaged this house, you bought it. You got this 10-year window where you can say, okay, well, you know what? Rates are down. A 30 years, 4.5, and I'm coming up on our 10-year. Let me just go ahead and refinance on a 30 for 4.5 so that it doesn't hit that, that whatever. If it goes up, I'm locked in.
And that's the thing that clients don't understand. It's like, hey, when you're on a 10-1 ARM, our goal is to refinance within that 10-year period. When rates go down, and they will eventually go down, is to refinance. There's no prepayment penalty on these loans. You can literally refinance anytime. You can actually refinance to a 30-year fixed loan or a 15-year fixed loan or into another ARM, because usually ARM products with us are a 1% or 1.5% better than what traditional mortgage rates are. Right. So it's just knowing those costs and just knowing what makes sense from a risk factor from a client perspective. And there's obviously anywhere from, like, I would say when you're discussing ARMs with the clients, there's about 5 to 7 questions that are continuously asked. Is there a prepayment penalty? No. Okay, that's done. Is there a balloon payment? Like on year 10, do I have to pay back this entire amount up front? No.
You don't have to refinance it.
You don't have to refinance if you don't want to. Can you refinance? You can refinance in 6 months, 6 years, year 9.5. It doesn't make a difference, Can you refinance into a fixed loan? Yes, you can go to a 30. You can go to a 15. Can you refinance into another ARM? Yes, you can refinance any way you want to. If you sell your house, do you have to pay any money back? No, none of those questions, right? So it's almost like what I hear from clients is like, well, Ravi, it's almost as if it's too good to be true.
Yes. Are there any downsides to it?
There's really not. Again, it's a risk factor, right? But it is only for a certain type of clientele.
Okay.
Gotta have 20% down or at least 10%, so we can look into maybe doing like an 80-10-10, which I can go into that as well. And your credit score has to be there, right? So if somebody's, let's say, for example, hypothetically speaking, is a first-time home buyer and their credit score is in the 600s and they need down payment assistance, well, guess what? This product's not for you. Right? Now, we still have those products, and those are still great products to get you into your home instead of paying your landlord, but these products this is the creative financing aspect of it.
Right.
So,
yeah, and I'm sure, these products with lower interest rates, higher credit score, a little bit more down payment than your typical minimum, right? I would go, and correct me if I'm wrong here. I'm open to being wrong.
Yeah.
But let's just say that we jump into a 7-1 ARM. We're approaching the end of year 7, and I'm at what would a 7 ARM be? Like 5?
As of today, it's like 5.5.
5.5%, right? So I'm about to adjust 2% up. If worst case scenario, I'm going to adjust 2% up on year 8.
Yeah.
I don't think I'm going to be able to afford that.
Yeah.
Right. The 2-point hike. So I need to refinance. I had something happen with my credit.
Okay.
So like in that case, like you're in an adjustable rate mortgage, it's about to adjust up at the end of the first lock period.
Yeah.
And your credit's not where it used to be.
Yeah.
So you can't refinance out of the thing, and your payment's about to go up. That might be a situation where if life happens, something kind of comes out of left field, that could be a risk.
Yeah.
Right.
That's a
you're
risk.
either going to need to be able to refinance yourself out of this thing, credit wise and equity wise, or you might have to sell it.
Yeah.
Like it's a possibility.
Yeah.
So.
And the thing about selling is you've had 7 years at a lower interest rate than being compared to a 30. So you've been building more equity month over month because your payment's less. You're borrowing money at a lower interest rate, right?
Right.
So when you do, let's say life happens, and it does. It happens to everybody. And if that happens and you cannot refinance, then yes, maybe we need to look into selling and get that money back, fix up what you guys need to fix up, pay off the things that you need to pay off, and then restart at that point.
But I would also say that's a good tip for anybody who is currently on an adjustable rate mortgage. If life has happened, if something's happened and you're about to adjust upward, people need to be getting in touch with you before they have to.
Yes.
To devise a plan. Hey, I've got 2 years. I want to make sure I'm not left holding the bag.
Yeah.
My credit score went down because whatever happened in your life that caused your credit score to mess up. Can you help me get back on track so that I can refinance this thing when the time comes? So that would be a tip. Anybody that's currently on an adjustable, I don't know why somebody would be on an adjustable rate mortgage. with rates being so low how they are, but it's possible.
Yeah. I think the main thing is eventually what happens, and we deal with this on a daily basis, is that when life happens, get in touch with the people that can provide the guidance to help you sooner than later.
No matter how embarrassing.
No matter how embarrassing it is, or no matter what the situation is, because the quicker they come to you or me, the better advice we can give them, and the quicker they can get back on the track they need to get it back on.
Yeah, because you're specialized in taking somebody's situation and analyzing it and making sure that, okay, all the cards on the table, I feel like we can do these things right here, and it's going to help you out so that you're not left in a situation that's going to be detrimental to your family and all that. So
100%. Yep.
So we talked about adjustable rate mortgages, the lock period. So the one on a 10-1 arm, the one part means it adjusts annually.
Yes.
And then every year. Each adjustable rate mortgage is going to have its own terms on how much it can adjust and what the caps are and stuff.
The caps, yeah.
Right now, you're saying common is 2% on year.
So for us, right, every product or every investor is different. For us, for example, our cap is 2% every year, 6% life cap. Right. So max life cap is what we call it.
You alluded to something that we used to do back in 2010, 11, 12, and it was that 80-10-10 product. We haven't done that in a long time. A lot of people who might be watching this or listening to it may need to refamiliarize themselves with we're not going to go deep on it.
Yeah.
But just talk about the concept of an 80-10-10 and why would we use it.
So I'm actually closing one next week, and it's my third client in the last 30 days that's doing this, and they're selling their house. They're making about $85,000 from the sale of their house. And for them to get up to 20% on their new home, they would be basically very, very close to using the funds, all the funds they make from the sale, to get into putting 20% down and getting into one of our 10-1 arms at a lower interest rate. So what we decided to do is, hey, let's do an 80-10-10, meaning you only put down 10% of your own money. I'll do an installment loan for the second 10, right, which is fixed over 15 years. No PMI, and then we still put you in this 10-1 arm at a lower interest rate. So what that does, it keeps half the money that they're making from the proceeds of the sale of their house in their pocket because they want to do some renovation with the homes. They wanted to update the kitchen and the bathroom, a new carpet, and also they had a auto loan that had like a $700 car payment that had a $25K balance. They can pay that off now. So from a monthly budget standpoint, not only are they saving anywhere from $300 to $400 a month by doing an 80-10-10 compared to just a traditional 10% down, 30-year mortgage with monthly mortgage insurance, but they also have enough to where they're eliminating $700 a monthly obligation.
Yeah.
So it's a matter of, like you said, analyzing everything, dissecting everything, and then coming up with that game plan of how to structure this and explaining it to the clients that, hey, this is what you're getting yourself into, right? Because the second somebody mentions an 80-10-10 at Thanksgiving, you're going to have 5 to 6 people talk about, no.
Everybody's got an opinion.
Everyone has an opinion, right? And everybody's situation is different. And only that person knows what their situation is. And a professional is the one that needs to guide them.
Right.
Point.
So what everybody's listening to right now is you're listening to a skilled loan officer, and don't get all red-faced on me here. But you're listening to a skilled loan officer who has experience in looking at all your puzzle pieces. Now, as a consumer, I've bought homes. I've gotten mortgages on most of my rental properties, and it is a pain in the butt for people to pull out all the financial data, people like me, because it's buried deep in a file somewhere, lost in an email somewhere. But essentially, it's cumbersome, right? And we don't know what we don't know, and the process is tough. But when you've got a loan officer that you can trust that is going to ask you all the questions, they're going to put all the pieces to the puzzle, lay them out on the table, and find out, okay, Mr. Smith, you're telling me that you want to do this. These are your goals. Everything works out here. Looking at your financial history and looking at your financial picture, let's talk about this loan product. And you're basically analyzing everything, and then you're kind of saying option 1 is your best option, or we could do option 2, and you kind of give them that choice on how they want to roll their finances out.
Yeah, 100%. Our goal is to make sure that they have multiple options, and everyone's different, right? People have short-term and long-term goals. Some people don't love debt. Some people love debt, meaning, hey, if I can borrow as much as I possibly can borrow and keep as much as I can in my pocket, well, they have that mentality of, I can buy an investment property in 6 months, or I can do this in a year, right? So everybody's mentality and their characteristics is different.
Well, and this isn't a dig on anybody, But there's some people out there that are in the mortgage industry or what have you that, called a one-trick pony.
Mm-hmm.
Like they have the same loan product that they try to push on everybody,
Yep.
and they do that without even looking into what people's scenarios are.
Yeah.
And same thing with the Thanksgiving table. We're going to have a lot of people sitting around the Thanksgiving table that when you start to mention that you're thinking about buying a house and throwing out the fact that you can get a great deal on a 10-1 ARM or a 7-year ARM because you're only going to be there for the next 5 years probably.
Yeah.
There's going to be a lot of people with opinions around this stuff.
Oh, 100%.
That aren't in the middle of knowing all the ins and outs of it.
And I always come up with the example like, you're mainly going to get advice from family members, mainly your parents and things like that. They grew up in a different era.
Mm-hmm.
They grew up in a sense of, hey, save 20%, go conventional, get the best interest rate, and things like that. And they push that to the next generation,
Mm-hmm.
right? We grew up hearing that. I grew up hearing that. And the second you mention that, they're always saying, oh, well, talk to my lender, talk to my person, right? Because that's who I went through. Well, that lender is great, don't get me wrong, but he did your parents' loan who had $300,000 in assets, had an 800 credit score, and has been banking with them for 25 years.
Right.
Your situation is going to be a little bit more unique. Maybe your credit score is not where we need it to be, or maybe your assets aren't where they have their assets at. And if that lender only knows one type of loan product, well, that's what they're going to push to you, and maybe that's not what the best option is for you guys.
So you're saying they need to get their assets in your office?
They need to get their assets in my office as soon as possible. Yes, they need to. And I always tell people, call how many ever people you want to call. End of the day, right? And what happens is when they hear from me, they start thinking, okay, well, it's too good to be true. They talk to somebody else, and they're like, well, this person said this person said that. And I was like, look, the more people you talk to, the more opinions you're going to get, right? It's like if you have a headache and you go on Google and you type in you have a headache, you're gonna list every little thing that's wrong with you.
And that's the thing. It's like everybody's dad, uncle, grandparents, everybody's got that opinion.
Yeah.
And quite frankly, they probably have an idea of what your finances are like, but they really don't know the full picture.
They don't know. And they don't know you and your goals, right? Because there's a lot of people that talking about money at the dinner table is kind of like taboo
for a lot of people.
Right?
Yeah.
So like it's easy for a client to talk to me because one, they don't know me like
You're
that.
the doctor.
I'm the doctor.
I can tell you everything about my finances, and you're going to tell me what my problems are and how to help me.
Yeah, and instead of being like, okay, well, why are you going through these issues, or why is this happening, right? No, that's not. This is about where you're at right now.
No judgment.
No judgment here.
Not like Aunt Betty, who's mad because you still haven't cashed her $5 check from your birthday.
Yeah.
So creative financing, getting the wheels back on track here. So there's been a lot of social media content, TikTok videos about these 2-1 buy downs. To be honest, I know very little about them. I know that from talking to you, some of the stuff, but let's unbox that for a second. When I see a 2-1 buy down, what's that mean and what's it going to cost me?
So hypothetically speaking, basically, a 2-1 buy down is where we get the sellers to pay X amount towards closing costs, which we use to buy the interest rate down. So let's say, for example, on a $350,000 purchase price, right? Your loan amount is $280,000. Okay, that means you're putting 20% down. On a 2-1 buy down, let's say if you're doing a traditional 30-year mortgage, let's say your rate is at 6.875. Your principal and interest is roughly about $1,840 a month.
Okay.
On a 2-1 buy down, what we would do is instead of being at 6.875 on the first year, you would be at 4.875. And 4.875, your payment would go down roughly to about $1,482 a month. Okay, so roughly what is that?
Dropping about $360.
$360, right? So 360 times 12, whatever that amount that you're saving on the first year, we have to get the sellers to pay for that.
Okay.
And closing costs.
So it's basically upfront interest.
Upfront interest.
Okay.
That's all it is. We're collecting upfront interest savings for the 2-1 and for the year 1, which is 2% lower, and then year 2, which is 1% lower, and we're collecting that from the seller upfront. So in this case,
so that'd be about $6,480.
Yes,
is that
about 65? Yeah, so round up. Let's say 6,500. So if we get the sellers to pay 6,500 towards closing costs, roughly, we can do a 2-1 buy down.
Okay. Right? So that first year we're saving $360. The next year we're saving about half of that amount.
Yep.
What would be a scenario where that would fit like a glove? Like, give me a scenario where is that just to kind of help get the buyer into the house?
It usually fits a glove for listing agents and sellers to get their house sold, right? If your house has been on the market for a week or 2 weeks or 3 weeks and you're kind of freaking out a little bit, which understandable because the last couple of years, last couple of years you didn't have to freak out, right? Mm-hmm. Everything was just flying off the shelves. It's a way to, instead of doing a price reduction on the listing itself, you're offering seller concessions. Like, hey, instead of me decreasing my purchase price to sell my house by 10 or 15,000, guess what? I'm just going to pay the buyer's closing costs up to 10,000. Then it is up to that lender to run the break-even points. Like, hey, if we're getting 10,000 in closing costs from the seller, are we going to use this to do a 2-1 buy down, or are we going to use it to permanently buy the interest rate down?
Okay, so yeah,
and then still pay for all your third-party costs such as an appraisal, title fees, insurance, taxes.
That's where the skill of a listing agent can come in with asking some questions to the buyer's agent. So in that situation, mm-hmm. I would ask the buyer's agent, how long do your clients plan to be in the home?
Yeah.
And then if they say, well, I mean, they're relocating here, they might get relocated in a couple of years. And I was like, well, what if we just saved them a ton of money every month on the mortgage?
Yeah.
You know, if they pay this price, we'll buy their mortgage rate down or do a 2-1 buy down.
Yeah.
They'll have a sweet payment for the next couple of years while they're here.
Yeah.
But if they're going to be there for the next 20 years, hey, this is their forever home.
Yeah.
In that case, you can buy down the rate more permanently, saves them more money long term.
You can do that, and again, even with the 2-1 buy down, you can still refinance anytime, mm-hmm. right? And 2 years is a long time. In our business, we've seen rates within 60 days go from 4.5% down to 3%, and within 6 months go from 3% all the way up to 6%, mm-hmm. right? So you're talking about a 2-year span. And what people think about a 2-1 buy down when they hear it, and I saw somebody make a post on Facebook where they were like, oh my God, lenders are talking about 2-1 buy down. What a piece of crap. And they had the crap the poop emoji on there, right? And I was like, it's not a piece of crap. It's just a way, and a 2-1 buy down has been available for 20, 30 years.
Oh yeah,
it's not
been
something
around
new.
Since the 80s.
Yeah, it's not something new. We're only talking about it because we need to talk about it in this high rate environment, right? But the thing is, when we qualify a buyer, we're qualifying them off year 3 interest rate. We're not qualifying them off.
It's not predatory at all.
Yeah, at all. Like we're not qualifying them off the 4.5. We're qualifying them off the 6.5, for example.
And the way that I look at all of these things is essentially nothing more than just tools in the toolbox.
Yeah.
And as agents, we've got to be skilled when it comes to talking with other agents and, hey, you've got a buyer for one of my listings. Let's have a conversation. What's your buyer really need? Well, they got 20% to put down, good credit, blah, blah, blah. Maybe the agent knows it. Maybe they don't. How long is your buyer going to be here? Mm-hmm. What's that look like? I just had a meeting with my team this morning and said, okay, if we are showing a house before we ever walk into the house, especially if we're working with a conventional buyer who has money to put down, doesn't matter. Before we walk into the house, we need to go look at the tax records of the county to find out what was the last mortgage recorded on that property. Mm-hmm. Was it an FHA, conventional, what have you?
Yeah.
Whatever. If it's an FHA mortgage, mm-hmm. it's an assumable mortgage most likely.
Yeah.
Right? Are all FHA mortgages assumable?
Mostly government loans, yes.
Most government loans are assumable. So we go in there and we may be able to make a better offer to the seller mm-hmm. price-wise and assume that mortgage on I think I ran the calculation earlier. If we can assume a mortgage at a lower rate might save the buyer $300 or $400 a month as opposed to today's rates. And if you're a conventional buyer and you've got 20% to put down, you can afford to buy a house with an FHA rate at a higher price and still save more money every month.
Yeah.
But the assumable loan thing, like I said earlier, it's like threading a needle. You have to like the house first. You're not just going to buy any old house just because you can snag a sweet interest rate. You got to like the house first. You got to go through the seller's loan servicing company. You got to jump through their hoops. You got to do all this stuff. There's a lot of the stars that have to line up to make that right.
For sure.
It's still a tool in the toolbox.
Yeah.
Right? These are just all things. There's nothing – I don't think there's anything going on in the mortgage industry that's bad these days. It's just we just need to understand them again.
Yeah. Everything's very highly regulated, right? I think the thing is like individuals think that, the best predictor for future behavior is past behavior. So they're looking back at those years when everything kind of hit the wall. But that is this era is completely different. I'm excited about the way the market is. I know you are as well, right? Mm-hmm. It's just it gives us a point to take a step back, reevaluate things. And like you said, these tools that have been sitting in our toolbox for years and years, guess what? We're cleaning them up now. We're like, hey, can we use these tools? And maybe we can, maybe we can't, right? It's not about that. It's now about being able to relearn how to use this tool and being able to kind of offer it to our clients at this point.
So if you don't mind, I'm going to switch gears for a second because there's a lot of feelings out there in the market. And Dr. A at Northern Kentucky University hit the nail on the head. It's the second time I've used a hammer and a nail analogy. But he hit the nail on the head when he said that the thing that's impacting the real estate industry the most right now is the uncertainty.
Yeah.
People, is the market going to crash? Is it not? What have you? What kind of conversations are you having with buyers that are they hesitant right now? Like how are people feeling when they come into your office, or if you talk to them about a mortgage? Like what are the big questions you're getting?
So some of the questions are like, hey, I'm paying X amount for my house right now. Is it going to be worth this in the future? Right? The one thing that we're blessed to be in this community, meaning like Northern Kentucky, Cincinnati market, is that everything that kind of happens nationwide doesn't usually get to us until probably about a couple of years later.
I think Mark Twain said it. It's just about 20 years later.
Yeah, we're always kind of the last ones to kind of get impacted by a lot of things, right? And real estate is not off the table on that, right? What I tell individuals is like it's basic economics, right? I had this conversation this morning. I was like, right now, the demand to purchase homes because of the way the interest rates are, they're lower than they were in the last 2 years, right? The supply hasn't really changed much. So what's happening is that, if the supply hasn't really changed much and the demand is going down, you're going to see a correction in pricing when it comes to listings and things like that. Maybe you're not going to get 50K over. You could still sell a pretty nice house and be in multiple offers and get what you want out of this, right? The thing is, if you wait a year, and rates will go down, you wait a year and a half or 2 years or whatever, one, you waited, so you paid rent for X amount of time that you're not getting back at this point, and landlords are raising rents every month now because inflation's hit them as well.
Right.
When rates go down, demand's going to go up, but the supply is still going to be around the same. It's not that everyone's going to start selling again, right? And when demand goes up, guess what? Now you're competing against 20 other people. You're paying over list price. Now you're getting rid of home inspections. You're not getting seller concessions. You're going to have to close in 2 weeks, and you're going to have to you're going to have to fulfill a lot of the seller's demands, when right now the playing field is kind of even, right?
And that's the thing I think buyers need to understand right now is that right this moment, or the end of 2022, buyers have a little more control.
Yeah, 100%.
Right, we're able to do inspections now.
Yeah.
It's common to see those come back. It's common to see. It was rare to see people waiving appraisals, but that happened.
Yeah.
But that's back now. People are doing full-on inspections. They're doing appraisals. And when there's an inspection issue, you actually have the ability to ask the seller to fix the problem.
Yeah.
And the thing that people need to understand is the market is not predicted to crash. Why? Because the number of homeowners right now that have over 700 credit scores that are in their mortgages right now is way
through the roof,
way up.
Yeah.
I think the average credit score of a homeowner right now is 704. I saw a stat on that. Fact check me, somebody. But credit scores are up. That means that people are proven to be paying their mortgages. The other thing is that if you bought a house in let's say the last 7 years, and it was like a long-term home for you, especially in the last 2, you've got a pretty sweet interest rate.
Yeah.
Probably refinanced, you're probably in the 3s.
Yeah.
Maybe in the low 4s. With interest rates being this high, it's like I don't see anybody just rushing to go sell their house because they've got a really good house with a really sweet interest rate on it right now, unless they have to.
Yeah.
So the number of sellers out there are going to remain low because people aren't going to jump out of their low interest rate mortgage to go hop into a higher interest rate mortgage just because.
Yeah.
We're going to see more motivated sellers out there, fewer, but more motivated sellers out there. And then the demand for buyers is down a little bit too. So with fewer buyers in the market, buyers do have the ability to jump in and take advantage of not being in a 30 offer situation on a house paying $100,000 over asking price.
100%. Yeah.
Yeah. Where do you see this going? I mean, I'm guessing you're probably part of conversations with mortgage lenders that are getting information from people who are watching like a hawk on the market. Like they're making predictions, and no statements that are about to happen are set in stone. But if you had to throw out where you think this is going to go,
we you hear both sides of the coin, right? You hear there's some agents out there that are hearing that rates are going to go up to 10, 11% in the first quarter of next year. And I'm just like, and they asked me, and I was like, look, first of all, if rates go up that high, we have bigger problems, right? Not just the housing market. We have bigger issues worldwide at this point with supply and demand and inflation and things like that. What we're forecasting is that probably within the second quarter of next year, we're going to see a slight decrease in rates. We're going to see some stability in the market to kind of be able to better predict how 2023 is kind of play out. This year was very unpredictable, and not just from our level of knowing what we know, but even from a higher level of the Feds. They don't even realize how bad it was, right? So now it's more so just kind of keeping an eye on inflation, keeping an eye on the CPL, letting some of this old data kind of get off the table, and then kind of get some stability into it.
Well, I think that's healthy too.
Yeah.
Right. I mean, I gave the analogy of slamming on the brakes when you see a cop. The Fed said, "Oh snap, CPI or inflation is getting kind of wild here." I think, what did it get up to that one time?
It was like 8.4, 8.6 or something.
It
like
was
that
up
nature.
there.
Yeah.
I mean, the numbers were up there. It was shocking enough to where they raised rates, and then mortgage rates ended up following. And then now that things are that was the kind of jam on the brake pedal, and now it's like, okay, the CPI numbers came out last week. They are not as bad as we expected that they would be. They're getting better, or they're not as bad as we thought they would. So let's ease up a little bit.
Yeah.
So it's giving us more hope that the market's going to kind of level out, and we're not going to be in this trajectory of unaffordability and all that.
Yeah.
But I think what's going to have to come back into equilibrium is that seller that sold their house last year, or even 2022, March, April, May. Yeah, your neighbors sold their house for that, but interest rates were also 3 or 4%.
Yeah.
And to be able to get a buyer to pay you that, you need to understand that their mortgage payment's going to be higher.
Yeah.
So home prices aren't coming down, in my opinion. I just believe that the demand was so high and the rates were so low that it caused people to do unpredictable things with price.
Yeah.
And we can't, we're in November of 2022 right now. We can't go back and use that comp from February.
No.
We're not going to be able to use a comp from February because it's a completely different landscape in the market right now. Not bad. It's just different. We can't compare apples to oranges and get the same result.
And again, it's all basic economics, right? Supply and demand. It's like back then, the supply was low and the demand was extremely high, which brings up prices. It's just people are gonna overpay.
Yeah.
And and you might have overpaid. That's okay. You overpaid borrowing money at 3% interest rate. So in reality, you didn't really overpay. You're still in a good spot. It's just that what I told people in 2020 and 2021. I'm sure you told most of your clients. I hope you don't plan on selling anytime soon. Like, make this your home for at least 5 to 7 years, because if you do, you will be where you need to be, to where you can sell your house and still have that equity built up, make that money that you want to make, and go ahead and purchase maybe your second home or your forever home.
It's crazy to think that people were paying $20,000, $30,000, $40,000, $50,000 over asking price. Yeah. And then when the rates go up a little bit, they're like, I don't want to buy right now. It's like, well, you were just throwing $50,000 over asking price last year, and the payment going up a few $100 is causing you to stop. Like, what is that?
Yeah.
But I think the reality is that if I were trying to sell my house today, looking at what I could have gotten last year versus what I can get this year, there's going to be a bit of denial.
Yeah.
I'm going to fight it a little bit. But like, man, but Bob across the street got this for his house, and like, why is my house not selling? My advice would be to listen to your agent.
Yeah.
Because I've worked with clients where I'm telling them, hey, I'm reading the market, I'm getting feedback from showings, we're getting feedback on price or condition or what have you. The price and the condition aren't matching up, or the location and the price aren't matching up. If your agent is giving you this feedback, check for the data, make sure that there's, that other homes are selling in the price point, check the days on market and things like that. But at the end of the day, it is okay to be in denial as long as you understand that yes, it's going to be, we're in a different market now.
Yeah.
Just because your neighbor sold theirs for that doesn't mean you can get it. But also just, make sure now's the right time to be selling.
Oh, yeah.
Don't just stick your house on the market because you want to test it out.
Well, the other thing is, and this has been kind of something that we were waiting on for a couple of years now, right? Like, working with a true professional now is more important than it has ever been. And I've been doing this for 8 years here locally. I would say probably within the last 8 years, this year alone is where true professionals show their value and know exactly what conversations need to be had, where you're going to separate yourself from everyone else at this point, right? And so it's almost as if you're a seller in this market, talk to who you need to talk to, but it's not as easy as, hey, my next door neighbor got their license a year ago and they sold 4 or 5 houses last year, but they've not really sold anything this year. Maybe you trust that person, and maybe they're good, don't get me wrong, but end of the day, this is not the market where you take a risk by hiring somebody that doesn't know what they're actually doing.
Yeah, there's agents that are in the market that are they've sold 2 houses in their career and they're the best agent ever. They're fantastic.
Yeah.
And there's agents who have sold 400 houses and they're just they're not that professional. But what I'll tell you is that there are agents right now in our market that have gotten in recently that have never reduced the price on a listing.
Yeah.
They've never had to make a price drop to get a house sold. They've never had to negotiate the price downward either.
Well, they didn't have to negotiate home inspection repairs
at all.
either. Yeah,
at all. So there is a skill. There's a skill that comes with being able to interpret, to ask the right questions.
Yeah.
Ask the right financial questions of people. How long are you going to be in the home? And then that way you and your lender are working together to get things done. So
for sure.
Anything else you want to add while you got the attention of all the fine people of Northern Kentucky?
Not really. I mean, end of the day, when you see creative financing, and your buyers see it, the main thing is to kind of have enough ammunition to be able to explain what that entitles and what that kind of looks like. And then, the media and social media and everything like that, they're going to go ahead and take stabs at what we're trying to do or what we're trying to accomplish for our buyers and our sellers. End of the day, there's a lot of people that have the best interest out for these people, right? Our clients and stuff like that. And being able to kind of, provide all these options to buyers and let them know the pros and cons. It's up to that buyer to kind of accept that, hey, yes, I know what I'm doing. This is right for me. And then that's it, right? Instead of having that, having that just aura of I'm going to put this current up. I don't want to talk about this stuff, and I'm just going to wait it out. And you can wait it out. You're just going to keep waiting and waiting and waiting, and you're never going to be a homeowner, which for some people that's okay, right? But you're just going to keep throwing money away in rent, and rent's going to keep going up,
Well, so in this market, the motivated people are the ones that are going to move.
Yeah.
That's what motivation means, right?
Yeah.
It makes you move. I'm growing out of my house. My house is too small for our family. My house is too big. I want to downsize. I inherited a home. I need something to do with it. Those people need to understand that there's all sorts of different instruments that can be used in helping you move. It could be an adjustable rate mortgage. It could be a 2-1 buy down helping you sell your house. It could be any of this stuff. Now that you know the tools exist, it's your job to connect with a professional, Ravi, and a real estate agent, myself, however that flows. But ask the right questions. You don't always know the right questions to ask, and if you get in front of a professional who can ask you the questions, then the truth comes out, and then we know how we can help you.
Yeah, so that's true. And that's the thing, right? We have conversations every day, so we eventually get to a point where we know what questions need to be asked, so we're answering them before you even think about asking that question. And that's where you want to be when you're working with a professional. Oh, I didn't even think about asking you this, or I didn't even think about talking about this. Well, guess what? I know you didn't, but this is something that we need to talk about because I've talked to 100 different other people, and out of that, 60 of them had this question. And so it's very important, right? So, but no, just being on top of it, work with professionals, try not to, family and friends, they're great, right? Family's obviously important, and they're going to have their own advice and whatnot, but end of the day, take it with a grain of salt, right? Because everyone's situation is different. So.
Thank them for the advice,
yeah.
Then go talk to a professional.
100%.
Yeah.
Yeah.
This has been the Real Estate Momentum Show. Thanks for tuning in. This is Ravi Patel with Guaranteed Rate, Aaron Smith with eXp Realty. Thanks for watching.